Hi everybody, it's Ian Beamer with Guaranteed Rate. Just coming to you once again. Today I'd like to talk to you about how we determine eligibility when qualifying for a mortgage. So there's actually four things that go into the equation when an underwriter or when a mortgage company is looking at a borrower's profile to determine whether or not they're eligible for a loan. So the first thing that goes into the equation is the collateral, the asset, the property that we're lending on. What is that property worth? Most of the time we order the appraisal on that property in order to determine that. We'll either use that appraisal. If it's a purchase, we'll either use the appraised value or we'll use the purchase price, whichever one's lower. So we'll use the more conservative of the two. If we've got a purchase contract, obviously, that's going to show market value as long as the two sides are unrelated, but the appraiser ultimately determines if that property is valued at that purchase price. So there are certain situations, especially these days, we're coming across it more and more, where an appraisal is not needed. There's actually an automated appraisal done when we run the file through an automated underwriting system based on what's on record for square footage, for bedroom count, bathroom count, condition of the property, and similar properties in the area. So there are certain situations where appraisals aren't needed, but for the most part, the appraisal determines the property value. So getting into that a little bit more, conventional loans will let you put down as little as 3%, so you only need 3% equity. If you're not a first-time home buyer, if you unfortunately or fortunately you make too much money, you may need 5% down on a conventional loan. FHA is available for borrowers as well. FHA will let you put down as little as 3.5%. VA loans are available for our veterans that are eligible. VA does offer 100% financing, and then obviously there's jumbo loans or loans on multi-unit properties, and those may require a larger down payment. Jumbo loans typically require about 20% down, although extremely qualified people may be able to qualify for 10% down or even 5% down on a jumbo loan, but the interest rates will reflect those options and those limited options. So next part about in determining whether or not somebody's eligible for a mortgage is income. So people always ask, okay, how much am I pre-approved up to? Am I pre-approved to $100,000, $200,000, $500,000, $1 million? Secret is you're actually not pre-approved for a loan amount. You're pre-approved for a payment. So the way we determine what you're eligible to borrow is we look at your pre-tax monthly income, and we typically use about 43% of the pre-tax monthly income to go towards your total monthly obligations. That's the proposed housing payment as well as the minimum payments on all other debt that shows up on the credit report. So quick example, if you're making about $120,000 a year, we'll keep it simple, $10,000 a month, 43% would give us $4,300 a month to spend on all expenses. So that's the proposed housing payment plus all other debt. So let's say you've got a car payment for $800, you've got a student loan for $600, you've got maybe some credit cards for $500. That leaves us about $2,400 to spend on your total housing payment. That does not include utilities, but it does include the principal and interest, taxes, insurance, and if needed, the mortgage insurance on that loan. So we can get into that on another video, but that goes into what they call the PITI payment, the principal and interest, taxes, and insurance, PITI. So that's your total proposed housing payment. 43% is generally the rule, although sometimes jumbo loans may want to be a little more conservative on that 43%. They may come down to 40, sometimes even 38%, as well as borrowers with maybe not the healthiest credit profile. So that brings me to the third step that goes into determining eligibility, credit. So typically you need at least a 620 credit score for a conventional loan. FHA will go down to 600 in some rare instances. You may be able to get away with 580 for a credit score on an FHA loan. Jumbo loans require at least a 680 in most cases. And then again, if you're looking to put less than 20% down on a jumbo loan, they may require 700, 720, sometimes even 740 and up. It just depends on the program. So credit scores often vary quite a bit. People will pull Credit Karma or get a credit score that maybe they got on a credit card statement, like a free app. Oftentimes the credit scores that the mortgage companies use differ quite a bit from the credit scores that you will pull on your own. Reason being, the credit system that we use is about 25, 30 years old. So it's antiquated. The rest of the world has moved on. If you pull credit for insurance, if you pull credit to get a car loan, get a credit card, cell phone, get overdraft protection on your checking account, they all use a different, more updated system than the mortgage industry uses. So don't shoot the messenger. It is what it is, but there are differences between our scoring systems and the scoring systems of other industries, so it does not always coincide. Fourth thing that goes in, we've covered credit, collateral, income. Fourth part that goes into determining a borrower's eligibility is assets. So your down payment or your equity in the home. So your assets need to, at the very least, be able to cover the down payment. Sometimes if it's an owner-occupied property or FHA, which is always owner-occupied, you can get a gift from a family member. It has to be a gift. It is not a loan. It is nothing that you have to repay, but you can get a gift for that down payment. Sometimes if it's investment property, gifts are not allowed. That down payment has to come from you. And if you own multiple investment properties, you may need reserves. So that'll be determined kind of by the program type. Jumbo loans often need reserves depending upon the size of the loan. Reserves just mean that you've got money left over after the closing, after we put down the down payment, to carry that monthly housing payment for a certain number of months, whether it's 6 months, sometimes 12 months. Sometimes you may need reserves across multiple properties if it's an investment property. So that's where the assets come in. So hopefully this helps. This is kind of just putting mortgage qualification into a nutshell. This is a quick video. Obviously there's a lot of if this then the other thing that can go into determining certain programs, may be able to waive reserves, may be able to be a little more flexible on credit scores. Like I said, VA does not require equity or a down payment. So there's little quirks here and there. Give me a call, make a comment below, and I'd be happy to answer any questions you might have. If you wouldn't mind, just please like this video, make a comment, and subscribe. And until next time, I'm Ian Beamer with Guaranteed Rate. Have a great day.